All right, so you know that a credit score is a very important part of getting a mortgage. But if you want to know exactly how it specifically either wastes or saves you money, go ahead and watch this video. Hey guys, this is Nobu with MakingSenseOfDebt.com, where we discuss understanding finances, leveraging debt, and finding your financial freedom, whatever that looks like to you. In today's video, I'm going to walk you through 4 different ways that your credit score actually impacts your mortgage and sometimes even costs you money. It's not about just getting a high credit score just because that credit score can actually impact you and affect your actual wallet. But before we get into that, my question for you is, what is your credit score goal for this year? Go ahead and drop that in the comments below. All right, so the first thing about a credit score when it comes to a mortgage, and maybe the most important thing, is that your credit score actually decides whether or not you get to be in the game at all. There are minimum credit scores when you apply for mortgages, and if you don't hit that minimum, you are not going to get that loan. So for example, for an FHA loan, the minimum credit score is 580. If you don't hit that minimum, you can't get the loan. So why do lenders even have these minimums? Banks are lending out several billions of dollars every day that are related to mortgages. And of course, they want to make sure they get paid. And so by putting these minimum credit scores in place, they're guaranteeing that their insurer will pay them in the event that somebody just decides not to pay their mortgage. If you aren't really sure where your credit score stands when it comes to buying a house, I'm gonna go ahead and link a video in the description box below showing you exactly where you can find the credit score that is used to qualify borrowers for mortgages. The second important way that your credit score is going to impact your mortgage is it is going to affect your interest rate that you are going to get. The higher your credit score, the lower your interest rate is. Why is it important for you to have a lower interest rate? Think of the interest rate as the fee that the bank is charging you to use their money. So let's say the bank gives you $100 and the interest rate is 10%. You're paying $10 to the bank to lend you that $100. Now, let's say your interest rate is 1%. Now you're paying that bank $1 to lend you that $100. And so think of that interest rate as the fee that you are paying the bank as a thank you for you to use their money to buy that house. So now, I don't know about you, but I would rather pay $1 for $100 as opposed to $10 for $100. And so the higher your credit score, the better chance you have of paying that $1 per $100. There are different ladders that bump you up into the lower interest rate. If you have a 619 or below, that's considered poor. You're going to have the higher interest rates. The next rank up from that is fair credit, and that's between 620 and 679. So 680 to 759 is good credit. And then the step above that is excellent credit, and that is a 760 score or above. And so with each of those steps that you take, the interest rate gets lower and lower as you go up. So you want to be as close to that 760 as possible to get the best rates that you can. So your credit score is going to absolutely impact your payment. The reason why is that your credit score is an important part of determining what your interest rate is. When you think about your payment for your mortgage, it's 4 major things that are in there. It's the principal, which is paying back the original amount that you owed. It is the interest, which is that fee to the bank that you're paying. It's your insurance on that building, and it's taxes as well. And so when you're thinking about that interest rate, the higher your interest rate, that means your mortgage score is going to be more every month. And conversely, if your interest rate is lower, you will have a cheaper mortgage payment. The fourth way that your credit score is going to impact your mortgage is that your credit score is going to be part of determining the amount that you qualify for specifically. Whenever you're qualifying for a mortgage, the lender is going to think about what's called your debt to income ratio. It's everything that you owe, all debts that you owe in relation to your income. And so when they're thinking about qualifying you for this mortgage, they're going to think about how much is the ratio between your debts and your salary when we include the mortgage payment as well. The lower that your mortgage payment is, the higher that you actually qualify for. And part of what makes a mortgage payment lower is your interest rate, which is determined by your credit score. And so it's all very related, but your credit score is in the core of this. So there you have it. You should be feeling a lot more confident in understanding why your credit score is so important and how it is so impactful to many factors in your mortgage, including your payment, your interest rates, and even the total amount that you actually qualify for. If you need help keeping track of all the different things that you need to get in order to buy a house, go ahead and grab my free home buyer checklist. I will go ahead and link to that in the description below. If you found this video helpful, go ahead and share this with just one friend that is looking into buying a house. With that, guys, thank you so much for watching. I will see you next time as we continue on our journey to financial freedom. Peace.